It's this screen of red in the broader markets. There is one stock which is doing well, and that is specialized equipment manufacturing company Standard Glass Lining Technologies. Debuted on the bourses with a premium of 22%, listing at 172 rupees versus its issue price of 140 rupees, and holding up with a gain of almost 25% as well. Anjaneyulu Pathuri, who is the Chief Financial Officer, and Nageshwara Rao Kandula, who is the Managing Director of the company, now join in to discuss the company's post-listing strategies. Thanks a lot, gentlemen, for joining in, and congratulations in an otherwise weak and wobbly market. You guys have done extremely well. The street likes what you've put on offer and has actually paid a 25% premium to that as well. So that not only gives you a reason to celebrate, but also some more responsibility. Mr. Kandula, I remember clearly when the last time you joined us, you did say that you are sure of 25% CAGR on your top line over the next few years. If you could give us a sense on a couple of more data points. One, will your margins hold at that 20% mark? And how soon can you become operational cash flow positive?
Last my interview time I said within six months we are going to cash flow positive. Recently also we collected collection is very positive way. Then coming 6 months we are going to positive cash flow. And second thing, we are focusing on more and more export, and 20% we are next year we are targeting to export, and our revenue also going to grow. We are discussing many projects and a very positive way, and this is going to continue sustain our top line and bottom line.
Okay, all right. Hi, Mr. Pathuri as well as Mr. Kandula. Congratulations first. Time to celebrate, guys, for you and your team. It's been a good listing. Markets are weak, but a lot of interest in your stock. So good news. We take that on board. You'll turn cash flow positive in the next 6 months. Now, since you're confident about your growth outlook,
yes,
fair to say that by the end of FY25, you do around 680 crores. And on that pace, for FY26, you're in that vicinity of around 850 crores. Should that be the aspiration on revenues?
This year we are confidently we can touch 650 to 670 in between approximately.
Okay.
And next year also we are going to maintain the next to 26 financial year also we are going to maintain the same growth.
Correct. So around 620 to 630 crores at least is what you'll do in FY26, with exports contributing around 20%, right?
Yes.
All right. And that gives you scope for margins to improve as well. So what should be, the margin outlook? Say, since your exports are going to be improving, your utilization levels will improve, which will give you operating leverage. What kind of margins can you do? Should it move up from this 20% odd mark?
No, margins going to increase 26 financial year definitely compared to 25 financial year, and revenue growth also going to increase compared to 25. Same growth we are going to maintain next year. Order book is very strong, and also many companies we are discussing. Pharma companies want end-to-end solution provider,
right?
Not a loose equipment solution supplier.
So, let's go across to Mr. Pathuri then. Mr. Pathuri, if you could give us a sense on how much will margins improve from here on? Exports, which are 15% of your sales in FY25, will turn to 20% in FY26. If you could give us a difference between the margin profile of domestic sales and exports.
See, if you look at the domestic sales, when it compared with export sales, obviously there will be a higher margins in the export sales. Considering the export sales is going to be increased in FY26 and FY26 and FY25 as well, then obviously there will be a significant change in the margins as compared to the previous years.
So that's exactly what we are trying to understand, Mr. Pathuri. How much is the difference in the margin between exports and domestics? You've given us a sense of FY26. Beyond that as well, at a steady state, how much do you expect exports to contribute to your sales? And as a result of which, where do we see margins? From 20%, do they go to 22%, 23%? Where do they settle?
If we go to somewhere around 30 to 35% of the export sales, obviously the bottom line also will go up by 5 to 6%.
Mr. Pathuri, what we're trying to understand is simply what is the margin difference between exports and domestic margins. For example,
Fine.
if you're doing in domestic margins, if you're doing, say,
Yeah.
15, 16%, similarly, export margins will be 21, 22%. So could you give us the margin differential between the two?
Correct.
Please go ahead.
Like today, I will clarify. Then domestic margins are today whatever pharma industry facing many challenges, and we are also facing domestic sales margins are very tight. Our company performing well due to only export sales. Again, if you today next year suppose 20% our export is we achieved, then our slightly today we have 13%. I think this year we are going to maybe 13% PAT and
No, sir,
20%
sir,
go to
sir,
EBITDA. Again,
sir,
it
we
will
get
going
the
to-
point. We get the point on the on the export contribution.
I'm going. No, one
Please
minute.
go ahead.
1 minute more than allow me. One more. I'm next. Next we are going to achieve. Then again we are going to increase PAT and EBITDA also. Coming to your question, compared to domestic versus export margins,
Yes.
compared to domestic and export is almost domestic margins compared to domestic margins very high, export margins I think more than 15-20% compared to domestic versus export margins.
So it'll be around, approximately 300 basis points difference between the two.
15 to 20%.
So that is, okay, 1,500 to 2,000 basis points is what you're saying.
Yes.
Is that on the margin? Well, what we'll do is actually, you know,
percent to 20%. I don't have about the base points, but I can say 15 to 20% more margins we are getting from export sales. That
okay,
is
we
my
take that
answer.
point. Yes, we take that point and we'll get more clarification later once you report your quarterly numbers as well. But for now, thank you so much for joining in. And it's a moment for you to celebrate 650 to 670 crore this year's revenue with 20% margins. Exports, which are currently 15% of your sales, will go on to 20% with an eventual aspiration of them going to around 30 to 35 odd percent as well. And all of that would mean better margins for your company, as the difference between the two is around 15 to 20 odd percent. Mr. Paturi, Mr. Kandula, thank you so much once again for joining in.